Well, you've seen already a divergence in some of the big US oil majors who are continuing on their path to expand their existing sources of energy, in contrast with some of the European majors like Shell and BP, which are taking a different stance in terms of wanting to reinvent themselves as a more sustainable sources of energy. I think for us that the point is more about the market underpricing the revenues they're going to generate from the existing sources of energy, and not really allowing enough pricing for that. There are these other options at their disposal in terms of trying to make acquisitions and change the way they operate. But for us, it's really the crunching down of their cost structures and their ability to generate extra profits at the level that oil prices are at and at the level of demand that's likely to be present for the next few years.
Mike, when I look at your conviction list as well, I can only find low conviction in two places and high conviction in one. And one of the trades that looks obvious from what you're saying is that just buy UK equities and pay for that by selling down aggressively on UK gilts. Why?
So it gets back to the point I was making earlier, which is really we think about what is priced into markets, and then we think about the likelihood of good and bad outcomes from holding those assets. So clearly, yields are super low, and we also happen to have just come through recession where you've had inflation pressures being suppressed heavily. So that environment is not one where, for the future returns, it's possible to really think of high probability scenarios where you're going to generate good returns out of UK gilts. We think that actually US government bonds offer a better alternative as a safer asset. Instead, I think UK equities have been tarnished with the fallout in the energy sector, with people also being concerned about cyclicality risk in financials, and of course, with concerns about Brexit, as we still don't have a negotiated deal yet. So those things we think weigh heavily on the pricing of UK equities. And as a consequence, when you look at how they've behaved and how they compare in terms of value, the UK equity market looks attractive relative to other stock markets, and UK gilts look unattractive relative to most other bond markets, and particularly the US.